in U.S. equities, on one hand, a cut is decent for their valuations because you're lowering the discount rate that you're comparing the valuations to. But also, if you are cutting because of soft economic indicators, that can impact the earnings side of a corporation. Whereas, something like gold or something like Bitcoin, for example, you have money, you don't have to worry about earnings. And so if you do get lower interest rates on dollars and treasuries, and you do get, just kind of more global activity from some of those debt burdens eased.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses Bitcoin and crypto. The German government's wallet now holds only 3,856 Bitcoin, a significant decrease in just 3 weeks. Recent selling activity has put downward pressure on the price of BTC, causing it to drop below $60,000. However, there are signs that a potential bottom is forming. The end of the German government's Bitcoin selling could contribute to finding a local price bottom. Technical analysis using the WOF method suggests a potential price bottom and a recovery above the psychological mark of $60,000. A well-known crypto analyst, Mustache, expressed optimism in a July 11th post, stating that BTC will likely surpass $60,000 again in the near future. Other indicators, such as the Coinbase premium, also point towards a local price bottom, as shown in a chart shared by crypto trader Marty Party. In a July 11th update, the Coinbase premium is used to measure the price discrepancies between Bitcoin on Coinbase, which is popular among US investors, and Binance. This premium indicates the level of demand for Bitcoin in the US compared to the global market, and lots of things Lyn Alden discusses, so please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
So that depends on, I think, other factors that are happening. So historically, when you look at rate cutting cycles, right now everyone's kind of hoping for rate cuts, but people should be careful what they wish for because, assets don't usually do very well in rate cutting cycles. And that's largely because the reason they're cutting rates is usually not good for equities and risk assets in general. That could be a little different coming off of like an inflation period, but overall, it's not been a great track record. Given the fiscal dominant situation in the U.S. and given the fact that the U.S. is unlikely to be very domestically stimulated by moderate rate cuts, we can look around and see, well, what would be stimulated by rate cuts? So one, as I mentioned before, is anything in the U.S. that does have fairly short-term debt could get a boost from rate cuts. But then also things like emerging markets, they have dollar-denominated debt. They struggle when the Fed is trying to be very tight and raising rates and all that. And they would benefit pretty rapidly from U.S. interest rates going down and kind of easing some of their debt burden in a way. So I think that emerging markets are a factor. And if you do get easing in emerging markets, that can be good for energy consumption. Which can be good for energy prices. In addition, precious metals, let's say gold, for example, that should benefit from the cuts because, in U.S. equities, on one hand, a cut is decent for their valuations because you're lowering the discount rate that you're comparing the valuations to. But also, if you are cutting because of soft economic indicators, that can impact the earnings side of a corporation. Whereas, something like gold or something like Bitcoin, for example, you have money, you don't have to worry about earnings. And so if you do get lower interest rates on dollars and treasuries, and you do get just kind of more global activity from some of those debt burdens eased, that should be good for monetary assets like gold.
Speaking of gold, Mancroft has a question here. The USA was on the International Gold Standard, Bretton Woods, in other words, from 1944 to 1971. Were there increases in prices, so-called price inflation, during that time, and what caused the price increases?
So historically, when you look at measures of CPI going back from the founding in the 1700s all the way until, say, 1914, there's virtually no price inflation. You had periods of price inflation because if you get basically any sort of demand exceeding supply, you can get periods of price inflation, but they would be offset by periods of outright deflation. So you still have that ebb and flow, but it generally was sideways. Um, and once we saw, in the, kind of after we started shifting more towards central banking, and then especially after 1971, that's when you started to see that hockey stick growth in CPI. Um, so, in theory, even on hard money, you can get inflation if you have a reduction in the supply of goods and services. So, for example, if hypothetically there's a war and we lose half of our manufacturing capacity and our money supply is unchanged, that money can buy fewer goods and services now. So you get inflation in prices even though you don't have money supply growth because that ratio still changed. So you still have ebbs and flows of what prices can do, but in that harder money environment, you don't have nearly as much inflation coming from the growth of the money supply and debasement. Most you see inflation around wars or other catastrophes that somehow kind of disrupt the available and growing supply of goods and services.
Bitcoin reached $63,000 during the July 15 Wall Street opening as traders searched for indications of additional gains. According to popular trader Peter Brandt, Bitcoin's price chart may be following a familiar pattern of ups and downs. He mentioned the length of the corrective phase in his analysis. Joel's fifth attempt at identifying a double top turned out to be a bear trap, as confirmed by the Jaw 13 close. The most likely scenario now is that the bears are trapped. However, if the close falls below $56,000, this interpretation would be negated. Some individuals were more confident in BTC's ability to firmly break away from its previous state. The behavior of certain traders and analysts has caused significant damage. According to his analysis, the Bitcoin downtrend has come to an end, as he informed his followers on July 15th. He also shared a chart on X, which showed a pattern of price action similar to previous instances after Bitcoin's latest block subsidy H in April. This observation goes beyond just the markets themselves. Bitcoin received a new boost on July 5th from a well-known macro factor. Here is the source. In a recent interview with CNBC, Larry Fink, the CEO of BlackRock, expressed his newfound belief in Bitcoin. He admitted that he had been a skeptic in the past, but after studying and learning about it, he changed his opinion. Fink now sees Bitcoin as a legitimate opportunity. BlackRock currently operates the world's largest spot. Bitcoin ETFs are ranked by their assets under management. Reacting to the interview, Bloomberg ETF analyst Eric Pines emphasized the significance of Larry Fink's continuous endorsements of Bitcoin as a legitimate asset class for everyday portfolios. The fact that BlackRock and other legacy firms like Fidelity are buying into Bitcoin provides comfort and reassurance to boomer advisors, enabling them to confidently allocate funds. The early success of these ETFs has been undeniable and will continue to grow. Let's get back to Lyn Alden interview.
Yeah, so I do think we have a lot of comparisons to the 70s. I've been emphasizing the 1940s even more. When people think of inflation, they often think of the 70s, but in some ways the 40s are a better comparison because in the 70s, most of the money creation was from bank lending. Homeowners, baby boomers were entering their home buying years, and so there was a higher period of credit formation combined with, U.S. going off the gold standard, a spike in oil prices. So you had both money supply growth and you had supply side disruptions. In the 40s, it was different because most of the money creation was coming from fiscal deficits, obviously associated with things like the war. And during the 30s and 40s, they had that rotation that I talked about from private debt to public debt. So in the aftermath of 1929 and throughout the 30s, you had that deflating private debt bubble. But then by the 40s, you got a lot of that rotation onto the public side where it was inflated away. And so in many cases, the 2010s were a lot like the 1930s of kind of, recovering from a banking crisis, gradually deleveraging a private debt bubble and rotating it toward the public side. Whereas the 2020s are a lot like the 40s in the sense that, we are starting to see more of that inflation. We've gotten through a lot of that rotation, and most of the money supply growth we've seen is because of fiscal. And now, unfortunately, we have wars as well. My original comparison didn't involve wars, but now we have wars as we have all sorts of issues there as well. So I do think the 40s are instructive. I think any scenario you can look at that involves fiscal dominance is instructive. So sometimes what emerging markets have gone through more recently in many cases is instructive. But in general, what we want to take away from this is that rate hikes become less effective at controlling inflation when deficits rather than bank lending are driving most of the money supply growth. And generally speaking, hard assets are a big component of where you want to be when kind of trying to protect yourself from those ongoing problems, because I don't think they're going away anytime soon in the U.S. And other developed markets.
James David Advance, the new running mate of Donald Trump, once referred to SEC Chair Gary Gensler as the most unfavorable individual in a recently released video. There is discussion about regulating the crypto industry. The video, which has been circulating on social media, shows Vance speaking at Remedy Fest, a private conference posted by Y Combinator and Bloomberg on February 28th. In my view, there is a candidate for the worst person, at least in terms of my substantive disagreement, and that is Gary Gensler. Vance believes that Gensler wants to inject politics way too much into the actual business of securities in the US. Vance also criticizes Gensler's approach to regulating blockchain and crypto, stating that it is the exact opposite of what it should be. This criticism was made in February 2022. Vance praised cryptocurrency as a potential solution to government interference when Canada's finance minister froze the bank accounts of a group of truckers who were protesting lockdowns. This is the reason why cryptocurrency is gaining momentum. The government may restrict your banking privileges based on your political beliefs. In a post dated February 16th, he mentioned his previous experience as a Republican senator in Ohio. At the age of 39, Vance has a diverse background, having served in the U.S. Marines and studied law at Yale. He then gained experience as a venture capitalist under the guidance of Peter Thiel, the founder of PayPal. In a recent financial disclosure report for the U.S. Senate, Vance revealed his investment in Bitcoin, with holdings ranging between $100,000 and $250,000. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.